the top 10 best passive income sources for retirement in Kenya. And if you're looking for a video about passive income sources for retirement, especially in Kenya, you are in the right place. So in this video, we've done a number of passive income sources before, but this one is specifically for retirement. Those who are planning for retirement, or they have got 2 years, 3 years into retirement, this video is for you. But before we talk about retirement, let us define something properly and clearly and set the stage for a video, because if you don't understand this part, most part of the video won't make sense. So what is passive income? As I've always said on this channel, that passive income is income that continues to pay you even when you are not actively working. We have got two types of income. We have got active income, we have got passive income. When you have to wake up each and every day and go to work, that is active income. But if you set up systems and mechanisms in place so that something keeps giving you money even if you're not going to work, then that is passive income. And so this is why passive income is very essential for retirees, because you are not trading hours for money and you are not dependent on salary. The asset that you create does the work, and you collect money or income at the end of the day. So passive income does not mean that you are earning without having to work. Remember, you have to set up initially. So why is passive income critical for retirement? As I've always said, that retirement is not about age. Retirement is about one question. When you stop working, when that day comes and you stop working, what continues to pay you? So during your working years, your job is your primary source of income. Your job is your primary income engine. But the day you retire, the engine shuts off. So if you don't replace it early enough with high income producing assets, your life must shrink, and it will shrink because you've not taken care of it early enough. So let's break down why passive income is critical for retirement. Number one, salary stops, but expenses do not. That is self-explanatory. When you retire, your salary ends. Your business income may slow down. Your earning capacity may reduce, but your expenses do not slow down. Food continues, rent continues, electricity continues, water bills continues, transport sometimes continues, and family obligations continues. Health, as I like saying, it does not respect budget, so it will also keep continuing. So retirement does not cancel bills. If income stops but expenses continues, you begin drawing down the savings, what you had saved. And once savings starts declining without a replacement, without replacing them, financial pressure begins. So passive income replaces the salary engine. Reason number two, inflation quietly erodes lifestyle. I've always said that the rate of inflation averages 6% in Kenya today. So if you put money somewhere and that money is not giving you returns that is more than 6%, your money is slowly losing value. So inflation does not retire. And so passive income investments, especially those that are tied to the markets, to real estate or dividend growth, will help you overcome inflation when it rises. Number three, longevity risk. You might live longer than your money. Life expectancy is increasing. Many retirees today will live 10 years, 20 years, 30 years after retirement. So that if you retire after 60, you may live up to 80 or 85, or sometimes even 90. That means that your money must last 3 decades. If you rely on your savings alone, or if you rely on your pension alone, you are guessing with your money, and your guessing game will not last you for long. So passive income changes the equation. So instead of hoping that money lasts, you build assets that continuously generate income even when you live up to 90. Reason number four, pension limitations and income concentration risk. I've always said that many retirees always depend on pension. They depend on pension scheme. They depend on rental income from one property. They depend on savings in a bank. Concentrating on one thing or two things during retirement in the current economy is risky, because if that single source of income underperforms or it delays, then you get affected. Then everything shifts. So your entire retirement becomes exposed. Passive income is therefore there to diversify your sources of income. So we have said that there are 4 reasons why passive income is critical for retirement. Number 1, salary. When salary stops, expenses will not. Number 2, inflation quietly erodes your lifestyle and your savings. Number 3, longevity risk. You might outlive longer than your money. And then number 4, pension limitations and income concentration risk. So passive income, and when we talk about passive income, it's not about luxury. Take note of that. It's about control. Do you have control about your money? Do you have control over your cash? Do you have control over inflation? Do you have control over longevity risk? And do you have control over your lifestyle? And so that's what we are doing in this video. Let's move to another key thing that you have to understand: the shift from savings to cash flow. I've always said on this platform again, once and again, that if you prioritize cash accumulation over cash flow, then you'll most likely end up with nothing. Many people think that retirement planning means saving money. Wrong. No. Savings alone are dangerous. Why? Because savings gets depleted, but cash flow sustains your earning capability. If you have 10 million shillings saved but no income strategy, you are slowly drawing down your capital. But if your assets can give you 120,000 per month in passive income, your capital will remain intact or even grow. So the goal of retirement is not to spend your savings per se, it's to build assets that will replace your salary, because hear me and hear me well, retirement is coming. Whether you are 20, you are 30, or you are 40, retirement is coming. And the earlier you start planning for it, the better for you. So I'm going to break down the best passive income sources available in Kenya, and not randomly but organized. I've organized this into 4 categories: capital preservation, fixed income, market-based growth and income, and then real estate exposure. I've done that to diversify, so that as you are going through this, you learn that it's about diversification, so that by the end of this video, you'll understand not just what to invest in, but how to structure retirement income system. So let's begin. Category number 1 is cash and capital preservation. This is your ability layer. It's a low risk, high liquidity, and emergency bucket. So under this, we have got 3 sources. We have got 2 best sources of income. Number 1 is high yield savings account. Take note that I'm using the word high yield, so that it's not just a normal account. And this high yield, I have to put here a disclaimer. It has to give you more than 6%, because the inflation rate in Kenya is 6%. If money sits idle in your current account, it's losing its value, because the inflation rate is 6%. So your money is losing value. So look for a savings account that has got over 6% of yields. There are some that have got 7%. So I will not go into details which account, but look for a high yield savings account. If you park 1 million at 6% in a high yield savings account, this equates to 60,000 per month annually, and this equates to around 5,000 per month. It's not exciting, yes, but this is where your emergency fund will live, short-term capital will sit, and liquidity is protected. So retirement without liquidity is very dangerous. You don't want to lock your money in a property, but when you need 10,000, you cannot afford. So this is your shocker absorber. Number 2, under cash and capital, we have got money market fund. Now we move a level up. Money market funds pull investor money and put together and invest in short-term government securities, as well as high debt vehicles. The providers include people like CIC, Britam, or Mutual. We have got independent ones like Etika Money Market Fund, which I constantly use. We have got Sanlam and many other. The typical returns are around 9% to 12% annually, but this varies on a particular year, on a particular month, on a particular day, and many other factors. The minimum investment can vary. A Tika money market fund is 100 shillings. We have got Sanlam, which is 2,000. We have got others at 10,000, 5,000. They vary. They are very liquid, which means that you can put your money today and get it out tomorrow if you have an emergency. These money market funds are much better than savings because the interest rates are relatively high. While high yield savings account will give you interest at, say, 6%, 7%, 5%. Money market funds will give you with around 9%, 10%, or 11%. Others might be higher, others might be lower. So MMFs are better than savings, but they are still relatively low risk. Category number 2, we have said category number 1, cash and capital. And under that, we've looked at high yield savings account. And number 2, we've looked at money market funds. Let's go to category number 2. These are fixed income. Fixed income, they give you predictable cash flow. Under this, we have got government bonds and treasury bills. We've broken down before how to invest in government bonds and how to invest in treasury bills. These are issued by Central Bank of Kenya. Treasury bills are in 3 categories. There are those that mature in 91 days, those that mature in 182 days, and there are those that mature in 1 year or 365 days. The minimum to invest in is 100,000. We've got treasury bonds. These are between 2 years to 30 years, and the minimum investment is 50,000 Kenyan shillings. The yields after range. Now, the yields, they vary depending on the tenure and the market cycle, but averagely, they give you between 10% to 17%. Example, if you invest in a bond that gives you 14% annual returns, then at the end of every year, you'll have 70,000 Kenyan shillings. And I've said, if you invest 500,000 at 14% per annum, that's the bond yield, it will be giving you 70,000 Kenyan shillings annually. And this will be something like around, you divide that by 2 to get, in 6 months, it will give you 35,000. Then in 1 month, we divide that 70 by 12, something like around 5,000, above 6,000, around 6,000, something above 6,000. Bonds and bills are predictable, they are structured, they are government backed. So no risk for losing money. So for retirees, predictability is your power. Let's go to another one. Under the fixed ones, we have got corporate bonds. Beyond government bonds, Kenyan companies issue corporate bonds so that instead of investing with the company, you can put your money in, instead of investing in the government bills, you can put your money in Kenyan companies. They have got higher yields, slightly higher risk. But who are these ideal for? Investors who want income higher than treasury bills or treasury bonds, but they still want structured payouts. When choosing a company to invest in the corporate bonds, always check credit rating, company financials, debt levels, and how it has been paying their investors. This is where due diligence really matters when it comes to investing. Category number 3, just a recap of category number 2. Say the category number 2 are fixed income, and we've talked about government bonds and treasury bills. We've mentioned corporate bonds, and we've mentioned those 2. So let's go to category number 3, and here we're talking about market-based income. Now, we move into assets that fight inflation for a long period of time. And the very first one is dividend stocks. You own part of the company through buying shares. You have heard about NSE, you've heard about buying shares for Safaricom, KCB Group, or any other company, Bamburi, Kakuzi, etc. Strong dividend paying companies on the Nairobi Securities Exchange are companies like Safaricom, KCB Group, Equity Bank Holdings, East Africa Breweries Limited, British American Tobacco TB, and many others. So dividend yields, they will normally vary between 4% to 10% depending on the performance of that particular year. So that if you invest 500,000, half a million, at 7% returns or yield, you are looking at 35,000 annually. plus capital growth potential. It's important for you to note the following: that stocks fluctuate. Retirement investors must diversify across sectors so that investors, if you decide to go into stocks, put some money into manufacturing companies, put some money into retailing companies, put some money into communication companies, put some money into the banking industry. So diversify. So under category 3, we've talked about dividend stocks. Let's talk about exchange traded funds, also known as ETFs. This is where many investors level up. An ETF, what does it do? An ETF allows you to invest in an entire basket of a company at once. Instead of picking individual stocks like S&P 500, this is not a Kenyan company, this is a US-based company, S&P 500, which picks the best performing stocks from 500 best performing stocks. Now, ETFs, you don't pick individual stocks, but you invest in one. So that you buy a technology ETF that already holds technology stocks. What does ETFs do? One of these 5 days will break down ETFs. So ETFs, they track an index. They have lower management fees than actively managed funds. They offer inbuilt diversification, and they reduce single company risk. They are normally purchased through brokerage accounts. Now, for Kenyan investors, this often means the following: opening an international brokerage account or accessing ETFs via global investment platforms. ETFs are very powerful. Listen to me. ETFs are very powerful for retirement because you get diversification, you get simplicity, you get lower maintenance costs or management costs, and then you get long-term growth exposure. If the ETF yields dividends, you also receive income distributions. This is one of the most efficient long-term wealth building tools that is available globally. So we have said we are on market-based income, and I've talked about dividend stocks. I've talked about ETFs or exchange-traded funds, and the last one is unit trusts, also known as mutual funds. Though we have broken them down, but let us go through briefly. If you don't want to manage stocks or ETFs yourself, professional fund managers will do it for you. And this is where mutual funds come in. The word mutual means something common. So the providers of mutual funds are companies like ICA Lion Group, ICA Lion Asset Management, Gen Africa Asset Managers, or Old Mutual Kenya. The returns they vary, but they vary between 10% to 18% historically, depending on the fund type. The minimum might be around 5,000 Kenya shillings, depending with the fund and with the company. They are best for long-term compounding. If you want to put some money somewhere between 5 and 10 years, consider mutual funds, consider unit trust. Let's go to the last category, real estate income. Real estate remains powerful, but you must structure it properly. You must put structures in place so that it serves you well. Under real estate, we have got REITs, real estate REITs, real estate investment trust funds. Then you have got rental property. Then you have got private equity. Let's go through them very fast. We've talked about REITs. REITs is where you want to invest in property, but you don't want to stress of dealing with tenants or building or stuff. So you invest in REITs listed on the Nairobi Securities Exchange. Examples in Kenya, we have got the Ilam Fahari I-REIT, then you have got the Econ Holdings. The typical yield for REITs is between 6% to 12% per annum. They have got lower entry barrier, no tenant management, quarterly income payout. Real estate rates basically means you are exposing yourself to real estate without operational headache or heartache, if we have those that affect your heart. Then you have got rental property, direct ownership. This is where you are buying land, you are building rentals, then you are leasing them out either for residential purposes or commercial purposes. The yields in Kenya currently is between 5% to 12%, depending on the region and the management efficiency. The advantages of rental property are rental income, property appreciation, and leverage. Disadvantages are things like illiquid. Rental is not liquid, so it's illiquid. Management heavy, as well as capital intensive. We can always add something like a vacancy. There's a time you have got a property, but you can't lease out, you can't give it out to people because they are vacant. So they are not fully passive unless professionally managed. Then finally, under real estate, we have got private equity. This is higher risk. Private equity involves investing in private companies before they go public, or helping scale a business, or for an exit. Your friend has a company, they want to expand, and they're looking for 2 million or 1 million. So what happens? You pump money into that company. When the value of that company increases, you become part of the company before the company goes public. So this is illiquid, but good for long term and has got higher return potential. It's not ideal for retirees that need steady monthly cash flows, because money might be locked somewhere for a long period of time. Finally, let's look at the real strategy allocation. Retirement security does not come from finding the best investment. There's no single investment that will give you 100,000 per month guaranteed, but you have to diversify. So, and that's where I talk about building a structure that will be able to sustain you. You have got some money in government bonds, some money in ETFs, some money in money market funds. That way, you'll be able to have a balanced portfolio. So I've done an example of an allocation for a Kenyan retiree. So put 30% in government bonds, 20% in money market funds for liquidity, 15% in dividend stocks, 10% in ETFs, another 10% in REITs, another 10% in unit trust funds, and 5% in high yield savings. Both averagely, if you blend both, then they're giving you between 11% to 14% return, depending on the annual cycle and other market factors. Remember, you have to diversify, and you have to look for sources that will enable you to be liquid most times. So this is how you retire without anxiety. So as I finish, retirement is not about stopping work. It's about replacing the income. Build assets that pay you. Build systems and build them strategically, build them systematically, and diversify your income, because that is how you achieve stability. That's how you achieve stable source of income with no job, no dependence, and no panic. If you love this video, then you will love these others that we have done, especially on how to attain 100,000 Kenyan shillings, or how to attain 50,000, or even how to attain 30,000. We've also done a series. I'll leave it for you here to have a look at it. And thank you for staying with me. I'll see you in the next video. Bye bye for now.